Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And welcome to today's episode, which has actually turned into a bit of a monster. We've got a lot to get through today, and maybe I would describe it as the much anticipated review of super fund returns for the 25 financial year. But really, it's more than that. I'm looking at really longer term returns and trying to set out some of the considerations that, I think people need to take into account when choosing a super fund, because it's a very important decision given 12% of your pre-tax income goes into superannuation each year. And really, if you dedicate probably not more than an hour per year, that hour is very, very well invested, because it will mean that you'll maximize your opportunities. You'll maximize the balance on an after-tax, after-fees basis over that time. And that could mean really the difference between perhaps a very comfortable retirement versus a not so comfortable retirement. So last week I prepared, the episode was really around the comparison of unrealized capital gains, and that episode really focused on fees and tax outcomes. And the assumption in that episode is that returns are constant between all the options. I guess today's episode sort of complements or builds on the information that I outlined in that episode, where I'm now going to introduce the returns element. And I think they're the three. I mean, there's some other considerations, non-financial considerations like service and cybersecurity and so forth, which I'll get into today. From a financial perspective, they're really the three main considerations: is taxation, fees, and returns. Okay, so let's get into it today then, and let's begin by just reviewing returns. Now, normally I'll look at the top 8 industry super funds, which are the largest funds. And don't forget, superannuation is a scale business, which means the more money you attract as a super fund, not necessarily the more investors or members in terms of people, but certainly the more money you attract. The theory is, it hasn't always played out in the Australian superannuation sector, unfortunately, but the theory is the more competitive you are able to be. So naturally, larger funds are going to have an advantage over smaller funds. And that's why I look at the top 8 industry funds. And as promised, I've added Vanguard Super into the mix as well in terms of the comparison. And I actually prepared an episode a few weeks back, episode number 361, that did a deep dive on Vanguard Super. So that's the only retail fund I've got included, mainly because really it is the lowest cost retail fund in Australia. So if we're going to make a comparison against the industry funds, that's the best one to go with. Now, today I've got a few tables and charts to share with you. Really difficult to do in a verbal format like a podcast. So it might be that more so than any other episode, you might want to refer to the blog on the website. And of course, the link is in the show notes as always. But the first start is really, let's look at performance. Let's look at how we've done this year, or how the funds have done this year. And I'll look at it into two categories. Balanced, defined by our research house, Lonsec, as between 60 and 76% in growth assets. So balanced is really looking at making sure we've got some growth assets, but then we've got some defensive assets to kind of smooth returns. And then I've compared the highest allocation to growth. So some options like UniSuper will have 100% growth. A lot of the funds are like 90% growth. That's the highest allocation you can get. And I have compared those two options to premixed options because, well, balanced, will suit some people, might suit some people that don't want to take as much risk. But previously I've argued that if you're invested in super for more than 10 years, so I guess that if you're 50 or younger, or more than 10 years away from retirement, I've previously argued you should be mostly, or if not all, growth. And that, whilst the volatility will be higher, absolutely, if we look at the evidence, the long-term returns will be higher. And we don't really need to worry about volatility with super because we can't access it anyway. We may as well just ride it out. And if volatility upsets us, well, then just stop looking at the super balance every day and you don't need to worry about it. So I'm really more focused on the growth comparison than the balance. Anyway, having said all that, this year, top performer in the balance category was Vanguard Super. 11.76% in terms of return. Number 2 was Australian Retirement Trust, ART. Probably seen those commercials on TV, 11.17%. So not too bad, just a little under Vanguard. And the worst performer was Australian Super Balanced, 9.5%. So a couple of percent below the leader there. I've also included fees, that is investment fees, in the table. And it's interesting to note that the investment fees for these options ranges between 0.21% to over 1% for these industry funds. And I think this is an important point. So of all these 9 options, one fee is very low and one fee is 5 times the amount of the lowest fee. Now, fees aren't that big a deal in a year that you get double-digit returns, but we're not always going to get double-digit returns. Fees are certain, returns are not. So if, your return was 1%, fees start to become a much larger proportion of the overall return. So it's something we need to be wise to. Having said all that, all the returns I'm quoting are after investment fees. So there is an argument to say, well, sometimes the more you pay, the more you get. Unfortunately, in financial services, or specifically with investments, it is not true. The less you pay, the more you keep, the more you get. Okay, let's look at the highest growth options then. The winner is Hostplus High Growth, 13.57%, and Vanguard Super was only just slightly under 13.48%. The lowest performer yet again was Australian Super, 10.6%. So, Australian Super is the largest fund in terms of money. And I said, it's a scale business, so they have, really competitive fee environments. In fact, the lowest investment fees of the industry funds, not lower than Vanguard, but of the industry funds. But as you can see here, just on the past year's performance, they've been underperforming. So big doesn't always mean better, I guess. But the key I highlight here is that Vanguard Super is certainly up there. Now, in the table, because Vanguard Super is relatively new, they don't even report 3-year returns yet because they haven't been around for 3 years. But what I've done is I've taken the diversified managed fund that's been around for more than 10 years and put those returns into the table as well. So on a 10-year basis, all growth, or as much growth as you can get, UniSuper tops the returns in 9.5%, but Vanguard's not too far behind it, 9.27%. However, in balanced, Vanguard it's sort of middle of the road, so it's not near the top. Now, the reason why Vanguard wouldn't have performed well over the last 10 years in balanced is that it's had an index exposure to bonds. Now, I don't want to go into it too deeply, but that wouldn't have served them well through 2022, where there was a surprise increase in interest rates. And an actively managed fund could have navigated that event perhaps a little better than what an index fund could do. But truly, I would describe it as a once in a lifetime event, but and they're still middle of the road. But I think what this data is telling us is, and we should kind of expect this, is that Vanguard Super as a strategy, returns are very good and very competitive. Although I have a slight caveat to that, which I'll get to at the end of today's episode. Now, in previous podcasts where I've reviewed annual super returns, I've talked about my concerns around the lack of transparency around unlisted investments. And these unlisted investments are held by most industry super funds, and how they revalue these investments. And in fact, ASIC and APRA, the regulators, have also expressed concern and written to them and invited them to improve their reporting regimes around these sorts of things. But the difficult thing is that it's a bit of a black box, right? No one really knows what they're investing in. No one really knows, how valuations are done. No one really can assess really the risk in a portfolio, if you like. Whereas with listed investments like share markets, the price discovery mechanism is really incredibly important. So every day, people around the world, institutions, individual investors, professional investors are trading stocks. That's traded in a very open and transparent manner. And so that's called price discovery because, you've got thousands of people just trading this one stock, all have access to publicly available information. So it gives us a good sense of what the asset is worth. And as a result, then we can calculate what the returns are worth as well. And my view is that since listed assets have generated around about 10% returns if you look over the last 30 or 40 years, and that's a good time period to look at when we're making decisions around superannuation for most people because we're in it for the long haul. My view would be, well, why do we need unlisted assets? Now, I know why the super funds need it because they've got too much money to invest. They need to find another home for it. But that's their problem, not mine. As a superannuation investor, I don't really care about that. I'm really just selfishly looking at my own situation and thinking about, well, how do I want to invest my monies? So to take it a step further, what I like to do is kind of unpack Australian share and international share performance and compare the funds on that benchmark. Because what you're really doing is comparing like for like, and you're removing the opaqueness of unlisted investments because, and I'm not suggesting they do this, but it's going to be a little bit easier to manipulate returns if I have a whole bunch of unlisted investments and I want to rise to the top of the league tables. And I've spoken about this in previous years where if you look at the returns through to May, Hostplus isn't doing so well. And then when you look at the returns through to June, that final month, they go and revalue their unlisted assets. All of a sudden, they're at the top of the table. And being at the top of the table is good for marketing. It attracts members' money. So, and then that's what people are sort of rewarded for. So let's remove the assets that I can manipulate and then let's look at the returns then. And that's what I sort of like to do. So I've done that again. I've got two tables on the website, international and Australian shares, where super is the best performer over the last year and even over 7 years. Australian super is the best over 10 years and even 5 and 3 years. So it's kind of interesting that Australian super has been the worst performer in their pre-mixed options, but the best performer in the Australian share market. It would kind of suggest that the unlisted assets that Australian super has, or the alternative investments, unlisted assets, whatever you want to call them, haven't performed that well. And that's fine. Different asset classes perform differently at different times. But I guess it shows that, well, comes back to the question, why would I want exposure to those assets when they don't have the same transparency as listed markets? So let's look at international shares. Aware Super is the best performer. They're over 5, 7 and 10 years. Cbus was the best performer over the last year. Again, we don't really look at 1 year returns. The interesting thing to note though is Australian Retirement Trust, ART, and Hostplus have not been really the top performers in any of these categories in terms of Australian shares and international shares, whereas they tend to be relatively high up the table in both growth and balanced options. That means that their assets outside of Australian shares and international shares, which I would argue should make up a large portion of the portfolio, have performed really well. Now, what we need to decide then, or what investors need to decide, if they, particularly if they're at ART or Hostplus, will that outperformance persist? You know, is that outperformance reliable, or are we concerned as members that maybe there's a bit of window dressing going on there? I'm not suggesting there is because I don't have that data, but it's just interesting. If I'm going to benchmark the performance of a fund manager, I want to do it in an open, transparent way. And I think looking at international and Australian shares in terms of those sub-asset classes and comparing them gives me a sense of what their performance is like. Why would they be much, much better in terms of performance in a different asset class than in the traditional listed asset classes, which again, should make up the vast proportion of your portfolio? So what I'm aiming to do here is just try and create a little bit more transparency, because what you really need to do is form a view of who's going to invest your money the best over the next 10, 20, 30 years, however long your time horizon is. And so past returns can be useful in doing that. But of course, there's no guarantees because, the people in the business change, the organization changes, the culture can change, all those sorts of things. So when what we're trying to assess is their core competency with respect to managing investments and managing returns over a longer period of time. Of course, the advantage of Vanguard, which again, if you look at an all growth or mostly growth scenario, is as a top performer, The advantage of Vanguard is it's very transparent, right? It's completely indexed, traditional market cap indexing. There's nothing going on there. It's 100% listed markets. So you don't need to worry about any opaqueness with, unlisted assets, all those sorts of things potentially coming home to roost in the future and upsetting future returns. Okay, let's talk about some other non-financial considerations that I think people should take into account when choosing a super fund. The first point I'd like to talk about is trustee director experience. And so the funds will have a trustee, of course, and there'll be a board of directors of that trustee. Essentially, they're the leaders of that business. Of course, many of them are non-executive directors, so they're not working in the business every day, but the management team is reporting to the board of directors of the trustee. Inside industry super funds, typically, it's enshrined in the law that we should have, or they need to have, an equal amount of employer representatives and an equal amount of employee representatives. And so typically the unions appoint the employee representatives and the employer representatives are typically appointed by industry bodies and so forth. The problem is that it's conceivable that the unions actually have influence over both employee and employer representatives. So for instance, the Master Builders Association is obviously an employer representative or can employer representatives, but I'm pretty sure the CMFEU has some sway over what's going on in the Master Builders Association. Now, if we go back to the early 90s when this law was written, we had employer and employee representatives to keep everyone honest, right? So that the employer wouldn't be able to less likely to mismanage the staff's retirement savings. And so that was necessary back then, but the funds have got so big now that the problem is that a lot of these people getting appointed to the board have very little to no experience in running a lot of money or in financial services generally. Now, I don't think we want everyone on the board to be a financial services expert. We want people, with a legal background, a sort of member services background, these sorts of things. So we want a well-rounded board, but we certainly want the board to have heaps of experience in it so they can make really great decisions. And when you look at the people on some of these boards, and I know people in the industry fund sector, and they've said to me, it's worrying. These people don't know what they're doing. They don't have much experience. They have no idea. And that's a really big problem. I mean, if it was a listed company and the board had no experience, the share price would be smashed by the market, of course. That's a listed company environment. What shouldn't we actually demand higher outcomes and better, more robustness over corporate governance and those sorts of things in the superannuation sector? Now, of course, there's an advantage for unions to have a bit more control over super funds because they get a lot of, in inverted commas, sponsorship and training money. All you need to do is do a Google. In fact, I've got a link in the blog, some of the articles that talk about how many millions of dollars the industry funds spend on these sorts of things, which ultimately go back into the unions' pockets. I don't think the equal representation model is any longer fit for purpose. I think the law should be we can have employee and employer representatives, but we need to have an equal or greater amount of independent directors with genuine expertise to provide that level of oversight. We're talking about trillions of dollars of Australians' money, and it really does need better management than when these laws were written 30 years ago. The next thing you want to think about is service, and this is a difficult one because unfortunately there's no real key metric here or advertised metric that you can really compare. But again, over the last 12 months, there's been a lot written about, really poor service, and the regulator has actually taken Australian Super and Cbus to court. They've sued them over, delay of payment of death benefits. But it can be something as simple as really long wait times on the phone, failing to actually respond to your requests. And whilst most of things can be done online now, you can change your investment option, update your binding death benefit nomination, do all these sorts of things online. When it comes time where you really need to speak to someone, a person, you want to be able to do that, particularly if it's related to your super. It's a really important aspect of your life. So then what I want to do is just touch on a couple of bits of data here where we've had, different bits of research and so forth. So CoreLogic just released a report only a couple of months ago. It spoke about, that the retail funds actually score better than industry funds. In fact, industry funds scored the lowest in terms of trust and service. And the only outlier there was interestingly that UniSuper ranked the highest in terms of most trusted and sort of best service. When you look at the complaints data, it shows that UniSuper, Hostplus, and Rest receive the fewest complaints per member per 10,000 members. That's how they measure it. That's some data that KPMG, APRA, and AFCA published. So I think, if it gets to an external complaint body, that's a real problem. And, it's a pretty good metric, I think, of how those funds are doing. And then one of the funds shared a chart from Super Ratings that looked at, call waiting times and looked at sort of small, medium, and larger funds and how they're doing. And Vanguard ranks or answers the phone within 31 to 60-second range, which is pretty good relative to, some of them taking, or 23% of them taking more than 2 minutes to answer a call. So that's something to just think about. This, unfortunately, as I said, there's no one thing that kind of wraps it all up to say this is the best or this is the highest rated fund. But service is something that you're going to have to think about. And I've had comments from listeners of the podcast to say, look, I'm happy to actually pay a little bit more if I can get some good service. But if I have a look at that, Vanguard hasn't been around for that long, although in that episode I spoke about a few weeks ago, the fund administrator they've appointed hasn't been caught up in any of the problem industry funds because they obviously do work for different funds. So it sounds like they've got themselves a good external administrator. Vanguard and UniSuper, again, kind of stand out as the best in this, but I admit there's no compelling absolute data on this. The next element you might want to think about is cybersecurity, with so much fraud and identity fraud and these sorts of things going on. This is going to become more of a concern, I think, that is people trying to steal money out of your super fund. So in April 25, there was an issue where that Australian Super, ART, Hostplus, and Rest were targeted by a cyber attack. And it's reported that members lost about $750,000 from that attack. A year earlier, in May 24, UniSuper members were locked out of their account for around about 2 weeks. Apparently, it was a configuration error with their service provider, so maybe not something they could deal with. Hester's been offline for 7 weeks, came back online in June. I think it was a planned outage, but, not so great outcomes there. And both APRA and ASIC, the regulators, have criticised the super funds for not doing enough in this space. I'm no cybersecurity expert, of course, but I think what you need to, so it's going to be really difficult to assess, how these funds are doing from that perspective. But I guess all you can do is worry about what you can control. And what you can control is using a long, unique password and enabling multi-factor authentication. And several funds now offer multi-factor authentication. Australian Super, ART, Rest, Hester, Vanguard Super, and UniSuper all offer 2FA. But I think what needs to happen here is the law needs to change. So in the UK, I can't remember if this was a few years ago, maybe 5 years ago, whatever it was, the UK changed the law to hold the banks liable for any fraudulent transactions. And as a result, because now they're on the hook for those fraudulent transactions, they take steps to, make sure that they do everything to avoid it. So, for instance, if there's a cyber attack inside Super or someone fraudulently steals your ID and transfers the money out of your Super, if the fund is on the hook for that, in terms of the liability for that, they'll put steps in place to avoid that. So, for example, a simple call, a phone call to you by a human being to say, hey, we've received this rollover request or we've received this request to transfer this money. Is this valid? Have you made this request? Just that simple process of doing that will greatly reduce the risk of fraud occurring. And this is wider than Super. The banks should be on the hook for this as well, but we really should demand that from our financial institutions. But what we really need is the government, the Australian federal government, to change the law to make it bring the onus on these institutions to take more responsibility. Now, it was only last week, so I probably don't need to remind you. Episode 366, I talked about the difference between pooled and unpooled funds. Of course, everything I've compared today is a pooled fund, which means that tax on unrealized capital gains is imputed in the unit price on a daily basis. So it's subtracted from your account, if you like. And in last week's episode, 366, I spoke about how using Australian Super's Members Direct product or a wrap account or a self-managed super fund, all being unpooled products, helps you avoid potentially paying any capital gains tax over your lifetime, which is a pretty considerable benefit. And I'll come back to that in a second when I reach my conclusion. But, there's two sides to every coin. So pooled funds, yes, certainly they're not as tax effective as unpooled funds. But it also means that there's no downside to switching super funds because there's no tax consequences associated with switching super funds. And back in 2019, the government banned any exit fees, superannuation exit fees. So there's no fees or tax consequences with switching super. Also, the government probably about 2 years ago mandated that all rollovers have to go through SuperStream. And SuperStream is a government mandated system that sort of standardizes data and payment processes. And so essentially what it means is when the fund receives all your information, they've got 3 business days to transfer the money across to the new fund. So it means switching funds, no fees, no tax consequences, and the longest it's going to take is 3 days, which means that you're out of the market for 3 days. So if the market really kicks off over that 3-day period, you miss out on those returns. But conversely, if it plummets, you also miss out on that reduction in value as well. And it's only 3 days. I mean, it's probably not going to make that much difference. So the only concern or consideration then when switching super funds is if you have any insurance inside your super fund. But what you could simply do in that regard is just leave a minimum balance in the fund. And you'd have to ask the super fund what that minimum balance is, and just enough to retain the insurance and pay for the premiums. And then you can roll your money out and do whatever you want to do with it. You just need to make sure that you check with the fund whether you need to do anything to keep that account active. So you might need to make a contribution every now and again. You might need to opt into that insurance every 1 or 2 years. They've changed. I mean, the law's changed a bit here, and each super fund has a different approach. Now, I'm not saying you should chop and change super funds every 6 months or 12 months or whatever it might be. What I'm saying is that there should be no reluctance if you're concerned or you reach a conclusion this fund's no longer serving your purposes. You should be aware that it's very simple and typically no cost except for insurance considerations, no cost associated with switching over, and it's a very quick process. And it all can be done, most of it, almost all of it can be done online. So there's really no reason why you should be with a substandard super fund. Now, before I get into today's conclusion, like wrap up the episode, I just want to address one question I had from a listener, which is, should I spread my money across 2 super funds? And the idea, I guess, behind that is spreading your fund manager risk or your superannuation manager risk. That is the risk that, Australian Super underperforms UniSuper or vice versa. So why don't you have, spread your eggs across multiple baskets? Obviously, the concern would be fees, because you're going to pay more admin or 2 lots of admin fees. But the admin fees inside super funds, we're only talking about a few $100s. So if you've got a pretty sizable balance from a percentage perspective, we're not talking about a lot of money. And reducing that performance risk in terms of, which fund's going to outperform over the longer term, I think is probably worth more than a couple of $100 a year. So I'm not really concerned about fees unless you've got very low balances, of course. So I think if you've got, and the way I like to look at it is probably from a family's perspective. So if we're adding, 2 spouses' balances together, that's really what you want to do is look at it from that perspective. So I think if a family has more than 400,000 of super, it would probably make sense to spread, use 2 different super funds in that regard. But there's no magic bullet, right? There's no magic number here where it becomes more important. It's really kind of a little bit up to you in terms of what risk that you want to take, but I don't think there's any downside to splitting across a couple of different funds. Okay, so let's get into the wrap up then. Okay, so who is the best fund? Well, I think based on historical data in terms of how Vanguard has performed over the last 10 years, particularly in the high growth sector, and the work that I did last week with respect to pooled versus unpooled funds, I think the best option is Australian Super's Members Direct option and invest 100% of the balance in the ETF VDHG, which again, Vanguard High Growth, as its 10-year returns are only slightly below the top performer. And the Members Direct product is very cost effective. As I said, helps you potentially avoid capital gains tax throughout your whole working life, which is a big plus. But of course, this option's not going to suit everyone. And really, it's probably most suitable to people that are sort of more engaged with their super and confident to, invest monies in an ETF and sort of managing it, because it's not it should be really simple. I don't want to overcomplicate it, but it's not as simple as, a normal sort of pre-mixed option. Now, that conclusion is reached by looking at the last 10 years of returns and understanding the fees and tax implications and so forth. However, Vanguard relies solely on traditional market cap indexing. And this approach has worked well over the past decade because growth has outperformed value. And I've talked about this earlier this year. And whereas traditional market cap indexing is more of a quasi growth index because the allocation to each individual stock within that index is linked to the share price. And so if the share price is running, then you're investing, or proportionally more of your money goes into that one particular stock. So it's very, very much sort of momentum and growth that's driving it. Whereas if you look at the data since 1927, particularly in the US market, value on average has outperformed over that period of time, since almost 100 years, by about 4.4%. So the fact that growth has outperformed value over the last 10 years is actually a bit of an anomaly. And so my concern is that mean reversion might eventually kick in, and where value starts to outperform growth, or putting it differently, growth underperforms. Now, when we think about growth stocks, we think about technology. And of course, it's possible that things like AI, robotics, and just the broader technology sector could continue to thrive for another decade or even longer than that. Given technology is predominantly so very growth orientated. So that's another thing, right? You could form a view, say, look, technology is going to kill it over the next decade. So I think it could continue, and it could. However, we don't need a switch away from technology for value to outperform. What we need is investor sentiment to invariably shift from a growth at any cost mindset to seeking a growth at a rational or justifiable price. I'm planning to record an episode next few weeks to talk about how markets are really kind of disconnected with reality at the moment. We've got so much going on, everywhere, that, every asset class is performing well. It doesn't make a lot of sense. So that's what I'm talking about, a growth at any cost. It's sort of market is like, well, we just love it. I don't care. It's trading at a 60 times PE. We think it's a great stock. We're all in. At some point, that will change. And as I said, investor sentiment will be, we're happy with growth. We understand the AI story, the robotic story, but we're not prepared to pay 60 times PE. Anyway, if you kind of share that concern, that an acknowledgement that traditional market cap indexing, yes, it's done really well over the last 10 years because growth has done well, but there's a risk there. If you share that concern, then you might want to use a super fund that blends different investment methodologies, including some active management. And in that case, UniSuper will probably be the most, or appears to be the most consistent performer in that space. Now, finally, I want to talk about wrap platforms and when they might be useful, because in last week's analysis, I concluded that wrap platforms were between 0.15 and 0.22% more expensive than Australian Super's Member Direct option. But, the advantage of a wrap platform is you get access to a wider range of rules-based investment methodologies in addition to traditional market cap indexing. And I gave you last week, I shared an example of X20 versus the general market. Because at the beginning of this year, I spoke about, look, the Aussie market's dominated by banks and miners. That's a bit of a risk. Banks have done really well. Maybe the BetaShares X20 ETF will help diversify some of that risk. And if you just look at the 25 financial year, which is only 1 year, it's not compelling data, but if we just look at that in terms of being able to evidence of able to structure a portfolio that reduces the portfolio risk and exposes the portfolio to higher returns, or you look at 25-year return, X20 return 16%, and the general index 13.7. So you can see that it's not difficult to bridge a fee gap of between 0.15 and 0.2%, just rounded. It's not difficult to bridge that gap if you've got, access to, more than just one index methodology. So then the question would be, Stuart, when do we use a wrap platform? Because of course you need the expertise to construct that portfolio for you if you don't have that expertise and experience to do it yourself. Expertise and knowledge is one thing, experience is equally, if not more important. Well, there's no hard and fast rules here, and there's going to be exceptions to every situation, but I just sort of generally thought about it that if there's reasons to engage an advisor, so matters other than super, to justify ongoing advice, and you had at a family level more than 400,000 of super, it probably makes sense to use a wrap platform. So if, because you're already paying the advisor to do something, they may as well put your money on a wrap platform. However, if you don't have anything else that an advisor can help with, and it's really just looking after your super, I think you probably need a total balance between you and your spouse of about $1 million to justify engaging a financial advisor just to look after your super, if you believe that using a wrap platform will be the best way to go in terms of maximizing returns on an after fees, after tax basis. Now, of course, these are just generalizations, but I just wanted to give people a general sense of, if I wanted to use a wrap platform and I need to pay an advisor to do that, when does it make sense to do that? But of course, there's going to be exceptions that prove that rule. Okay, much longer episode today, but there was a lot to get through. I hope it really helps people make better decisions with respect to choosing a super fund. As I've said many times, I'll continue to produce the same updated episode each year. It seems like each year the episode gets longer and there's more data to include and so forth. So that's great. Hopefully next year will be even better again. After recording this podcast episode, I received a very helpful email from a listener. So I just want to jump in with and add these additional comments. And this listener wrote in about the Australian Super's Member Direct product and said that he learnt a few things from he uses the product that he wasn't aware of before he went in, and he'd like to share these experiences with listeners, which is fantastic. And I guess, one thing is that I've found is that there's always idiosyncrasies with almost all financial products, whether it's a mortgage or whether it's a wrap platform or investment or anything like that. Sometimes they have these little things that don't work quite well. That they'll never tell you about until you go into they're not deal killers, but they're things that you would have liked to know about. So it's great to receive this feedback. And if I talk about any products, I mean obviously the ones that I talk about that we use ourselves personally and for clients, we're going to know about. But if I ever talk about products like Australian Super's Member Direct product, which really is a product used by really many advisors, it's great to receive this feedback. Okay, let me get into it. There's 3 observations that this person was very kind enough to share about it. Firstly, you have to invest at least 20% of your balance in a pre-mixed option like high growth. So unlike what I have said in the podcast, you can't put 100% into the index fund VDHG. You can only put 80% into that fund, and the rest has to go into high growth. The second issue is that it doesn't support transition to retirement. I don't want to get into what is transition to retirement, but you might use a transition to retirement if you want to even up balances between you and your spouse while you're still working, but you're older than 60. They're the situations when we use transition to retirement. And then the last one is when you roll or change your member direct account from accumulation into pension. And this is a very important change because this is when those unrealized capital gains will disappear. You have to move 100% of the balance. There's no partial movements into pension. Not a big deal unless you have more than the transfer balance cap, which is $2 million. So if you had more than $2 million in the investor direct holding, you would actually have to sell down and crystallize capital gains tax, sell down 2 million and then move it across. So again, it's not necessarily the end of the world, but just something to be mindful of. And I think if you had such a high balance like that, as I've discussed in this episode, I don't think Members Director, which is a pretty simple, low-cost product, I think if you've got a very high balance, you probably want to invest your monies using more diversified and evidence-based index strategies. Okay, great feedback from that listener. Thanks so much for sharing it. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.